This is the WealthAbility Show with Tom Wheelwright. Way more money, way less taxes.
Welcome to the WealthAbility Show, where we're always discovering how to make way more money and pay way less tax. Hi, this is Tom Wheelwright, your host, founder, and CEO of WealthAbility. So China and the US are in this battle for global supremacy, or at least from an economic standpoint. And so today, what you're going to discover is how this battle is really a financial Cold War and how currency, taxes, and technology play into this. And I'm particularly interested in the currency and the taxes part of it. So we have a very special guest, James Folk, who is an expert in this area, wrote the book, Financial Cold War. James, it is awesome and a great pleasure to have you.
Thank you so much for having me, Tom.
So can you just tell us a little bit about yourself and how you got into this area?
I kind of stumbled into kind of by accident. I grew up in Hong Kong, had a very typical middle-class upbringing here. And then I, like a lot of people in Hong Kong, had a bit of an interest in financial markets. There was a huge boom going on through my childhood. But after university, I got a job working in investment banking. And so started to get an understanding of how the financial system works. Had an opportunity to live in different parts of the world, looked at how financial markets really affected not just people in their pockets, but whole societies as well. Working in Russia, living and studying in China, these countries went through massive transformations after they made that step transition towards opening up to financial markets. Then I stumbled into this job by almost complete fluke at the Hong Kong Stock Exchange back in 2012 and spent 10 years there almost. And, when you talk about stock exchanges, you're thinking about trading, clearing, settlements. These are probably not the most exciting parts of financial markets, but the plumbing that goes into these things has a massive impact on how the system operates. And it's a really completely overlooked segment of the financial universe. And through my work there, was dealing with a lot of policymakers and started to really get a very granular understanding, top down and bottom up, how the financial system worked. And the reason why I wrote the book was because I felt that this was an area that actually even many top policymakers don't have a great understanding of. So I wanted to explain to people how imbalances in the system were driving a lot of the social tensions you're seeing in both countries today, and a lot of the conflicts that you're now seeing between them.
No, I appreciate that. So if we can just step back so that everybody's on the same page here, and can you just briefly explain what does it mean when we say, or people say that the dollar is the reserve currency for the world? What is that briefly, what does that even mean?
Well, it's not just the reserve currency. So when you say it's the reserve currency, it's the currency is held as a store of value by people all around the world. But the dollar serves much greater purpose than that. It's also a medium of exchange, the primary medium of exchange for trade and investment around the world. And so everyone from different countries who operate in different currencies, when they meet up to do business, most people around the world are using dollars. And it is the demand for this international trade and investment for dollars that's driving part of the serious imbalances that you're seeing in the financial system today, which has had actually very negative consequences, not just on small emerging market countries that have been subject to a lot of the volatility, but also to the US itself.
So how does the fact that, everything's traded in dollars, particularly petroleum is traded in dollars. How does that affect U.S. consumers, U.S. business compared to the rest of the world?
So in a very simple example, what happens is because you've got all this demand for dollars for trade and investment, the US has to, as this trade and investment around the world grows, the US has to supply more and more dollars to the rest of the world. This means running a balance of payments deficit with the rest of the world, which is all very well so long as the US economy is growing at least as fast as the rest of the world. Mm. The problem today is that the US is already a huge, developed, mature economy, and it's not growing so fast. So when you have to keep supplying more and more dollars to the world, but you're not growing as fast, it means that you're going into ever higher levels of debt to perform that function. And so that debt has been driving big problems for not just the US government and a lot of US individuals, but also when you think about how economies and how countries rebalance over time, generally when you have higher growth and higher productivity growth in one country over another, over time, you see the currency of the lower growth country fall relative to the higher growth country. And that allows it to stimulate its exports and rebalance and for jobs and exports to reach some sort of equilibrium again. But because the dollar serves this global utility role, the demand for dollars from the rest of the world has meant that the dollar hasn't been able to adjust. So how this hits you in the US really depends a lot on where you sit in society. So it's not been all a bad thing. So if you've been a shareholder of a large US corporation that's been able to offshore part of your production to lower cost countries with undervalued currencies, you've benefited hugely because you've seen your costs go down, your profit margins go up, your share price go up. You've generally done a lot better. But if you've been a US manufacturing worker over this period of time, you've not done so well. What you've seen is you've seen job losses, you've seen displacement, and you've seen at best wage stagnation. And for a lot of America, this has been the reality for the last 30, 40 years.
Do you think this has an impact on the current inflation? I mean, is this because typically if you lose value, I mean, that's what you're talking about, is that if the dollar were to lose value, that would help rebalance, right? And it's clearly losing value when we're at the inflation rates we're at. So do you think this is part of the cause or part of the result, or not part of it at all?
Yeah, it's related. It's related, but the relationships are quite complex. So even though you've got very high inflation rates today in the US, actually the dollar hasn't seriously depreciated against other countries. In fact, against a lot of currencies, it's actually seen its value go up over the last few years. And in fact, one of the ironies is that even in 2008, when you had this massive subprime crisis in the US, when all hell broke loose in markets, people fled to dollars, and so the dollar went up.
It's all relative, right?
It's all relative. So you've actually, when you talk about inflation today, what you're seeing today is a rise in consumer price inflation.
Right.
And that really hurts people, because if their wages aren't going up and year on year, their basket of groceries that they're buying week in, week out is going up by 7% or more a year, that is going to hurt their lifestyle. That's going to hurt their ability to consume. But over the last 30 or 40 years, although you've had low consumer price inflation, you've had at the same time very high asset price inflation.
Correct.
This has been driven by a steadily reducing interest rate, downward trend in interest rates over time.
Of course, of course. I mean, as your interest rates reduce, by definition, it's an inverse relationship, right? Interest rates reduce, asset prices go up. It's true in any type of asset. So, but now China has clearly been making a concerted effort. For example, they want to get their currency in the basket of currencies. They made this concerted effort, and there's this big, literally this Cold War going on with US and China. So how's the currency affecting that?
In essence, when you talk about interest rate policies, when you talk about exchange rate policies, when you talk about taxation, all of these are mechanisms that distribute wealth and income around society. And as these levers have skewed the distribution of wealth and income in society to more narrow groups, and you've had greater levels of wealth and income disparity, you've generally had higher social tensions in society, in the domestic society. What's happened is, as these domestic tensions have built up and started spilling over, that there's a great temptation to look for reasons for that, and that the reasons for most people are just way too complicated to fully understand, and sometimes the easy answers that they've been offered is that, well, it's because China's stealing our jobs, they're raping our country, etc. And similarly, when you have problems in China, there's a great tendency amongst politicians to blame outside forces, and sometimes there's some element of truth in some of what they say, but it's not the whole picture. And when they focus on dealing with these or blaming these problems on the outside, it really diverts attention from dealing with the domestic problems that often lie at the root of a lot of these problems. And so as these problems haven't been dealt with, and as both countries to a greater or lesser extent have turned to a greater level of populist nationalism, that this has fomented tensions between the two countries, which, if you allow to continue, we've seen time and again throughout history that the consequences of this type of environment can be extremely dangerous and catastrophic for the people who live through them.
You mentioned this narrowing of who has the wealth, basically. Okay, the wealth disparity. Do you see that as a result of asset prices? You also mentioned taxation. Can you kind of just explain what you mean by that?
Ultimately, when you have monetary policy that drives the boom in asset prices, the people who have assets benefit hugely from that.
Sure.
At the same time, if interest rates are coming down because consumer prices are staying low, generally you've got stable prices, but also generally you're not seeing a huge uptick in wages for most workers across society. So that's part of the monetary reason for wealth getting concentrated. In taxes, it comes down to a lot of different things, some of them practical, some of them ideological. In the 1970s, you had these huge rates of tax in the Western world, and they served as a big disincentive to innovation, to entrepreneurship,
right,
and job creation. And we certainly don't want to go back to them. But over time, when you have a swing back from these extremes, sometimes the pendulum swings too far to the other extreme. And what I mean by this is that you quite often see in many countries today that the wealthiest people in society paying far lower rates of taxation than average middle class workers. Now, there's a very good reason for that. There's a very good practical reason for this as well, which is that as economies have globalized, as trade and investment around the world has globalized, all countries want to attract investment to themselves. Inherently, capital can move at the touch of a button. It's a lot more difficult for people to sell their house, up sticks,
of course,
move their families to a different country or a different state even. And so it's a lot easier for countries to tax labor than to tax capital. And so this kind of fiscal competition between countries and even between different states in the United States has driven these slightly balmy tax systems that have become more and more regressive rather than progressive. And they've generally become more and more unfair to average middle-class workers who've seen their tax burdens go up, while the very wealthiest in society and large corporations have seen their tax burdens relatively fall.
Well, so let's talk about that for a minute, since that's my area. And in fact, I've got a book coming out on this. Are you talking about, I just want to be clear on who we're talking about, because obviously, if you're a football player in the NFL, you're paying high taxes. If you're an entertainer, you're paying high taxes. If you're a doctor or a lawyer, you're paying high taxes. None of those people are paying lower taxes now than they were in the 70s and 80s, because in the 70s and 80s, we had huge tax shelters and huge opportunities to reduce taxes. And now the base for taxation in the United States is much, much broader since 1986. And so if you'll recall, in 1986, that was a revenue neutral bill. So we brought the tax rates down from 50 to 28% without decreasing revenue. Well, the way they did that was broadening the tax base. So more things were taxed. So for example, an attorney who invests in a real estate deal can't get those tax benefits anymore. Okay, that's called passive loss, right? So what they did was, and I think you're right, I think there is much more of a burden on the wage earner and also on the professional. Now, when it comes to asset prices, and I'm curious as to your thoughts as to how to solve this, is that as the asset prices go up, take the Wall Street asset prices. So you're talking about public stocks, right? Those go up in prices. Those who hold a lot of those stocks certainly have tremendously benefited, and they're paying no tax because they don't pay tax until they sell the asset, right? So my question is, are you talking about those people, or are you talking about the business owner that puts all his money back into his business and doesn't pay tax because he doesn't take the money out?
As you know, tax is a very complicated thing, and it's very dangerous to generalize. But I think if I can pick out a few examples of what I mean. So you're exactly right. So how you get taxed quite often is a function of the composition of your
absolutely
your income,
how you make your money. Yep.
And the composition of your assets. Now, for most people, the largest asset that they own is their home, and
correct.
So they live in it. They pay their property taxes. That's all fair. But for the wealthier part of the population, they tend to have, they not just own their home, but they tend to have other assets like stocks, like private equity investments, and so forth. And you do pay capital gains tax on your stocks, but you're not paying capital gains tax at the same rate that you're paying on your income.
Except you're actually paying a higher rate because you've actually paid tax twice. You paid it once when the corporation earned the income, and then you pay a second time when you sell the stock. So the tax on the corporation is actually tax on the shareholder, right? I mean, corporations aren't people. So the tax on the corporations is the tax on the shareholder. So if you've got a 21% tax, and then when you distribute the money as a dividend or you sell the stock, you've got another really 24% tax now in the US. Now you've got actually a 40% tax rate on that income. So I'm trying to understand how this is a lower tax rate.
So okay, so we're going to have some fun here. So I'm glad you brought up corporate tax, because this is an area where a lot of the games are played in a big way, and where actually the US has been at a huge disadvantage, because when you had the beginnings of globalization of US businesses, you had different tax regimes for those corporations' taxes in the US, and you had different views on how their overseas income should be taxed. You know,
Right.
some argued that they should be taxed no higher than the local country in which they were doing business, because otherwise they wouldn't be competitive with businesses who are operating in other countries. Others argued that they should be taxed at the US tax rate, because otherwise it would give them an incentive to offshore those jobs. Ultimately, it became a bit of a fudge where different types of income were treated in different ways. And
Sure.
certain types
Very,
of income,
very
like
complex. Correct.
passive income on patents and intellectual property were treated in a different way to
True.
earnings that were invested back into the business in other countries, whether it's in plants, manufacturing,
Sure, of course.
and so forth. And so over time, companies got smarter and smarter in the way that they either structured themselves or they lobbied for tax codes to be changed, where they're now able to sell part of the patents or intellectual property into an offshore entity in a low tax jurisdiction, where essentially there's a charge on, if they're manufacturing in the US or they're manufacturing elsewhere, irrespective of the fact that the intellectual property was developed in the US, it was developed because of the education system that was provided in the US and all the infrastructure and other legacy investment that the US has made, that those companies have been able to move their tax burden, significantly reduce their tax burden by moving that so-called intellectual property or patent rights into low tax jurisdictions, and then make a charge back to the US manufacturing or overseas production plants manufacturing whatever good or service it is. And so the games that are being played by big corporations have contributed very significantly to two things. One is that simply if the companies are not paying taxes in the places that they're generating their income. Now, you pointed out to me that, well, if you're a US taxpayer and you're a shareholder in these companies, you might be getting taxed twice.
Correct.
Well, that may be the case, but also there are a huge number of foreign shareholders in US corporations who may not be paying any tax whatsoever in the US, but who are also then benefiting from the tax sheltering that these companies are doing, and that the US is not getting the rightful tax take based on the historic investment that's been made in the US to enable those companies to generate the sort of earnings that they do.
Right. Of course.
That's just one example.
The argument would be that changed substantially in 2017. The whole idea there was to prevent companies from going overseas. And then you have the global tax regime coming in with the 15% global minimum tax, which presumably would prevent those tax haven countries. For example, it used to be a lot easier. I mean, you take, for example, Apple and Google and some of these really big companies that have located in Ireland, right? Basically, that's where you're talking about is they've got this 12% tax in Ireland versus what used to be a 35% tax in the US, which was a very big swing, which is a huge incentive to move to Ireland. Now you've taken that incentive substantially away. And then if you move that Irish tax, which looks like they're going to have to move their tax to 15% under the global tax accord. So do you think that, I'm just curious, do you think that global tax, the whole idea of going to a global minimum tax, do you think that will have a benefit here? Do you think that will help alleviate what you assert is that issue?
I think it's a good first step, but you have to look at what the substance of the G7 agreement that was entered into last year. And I won't bore you with all the details of it, but the reality is that agreement so far lacks a lot of teeth. So
true.
The headline of 15% sounds really good, but in practice, many companies can structure themselves in a way still that will allow them to avoid those sorts of minimum tax rates on their global income, and it doesn't avoid still a lot of the tax shifting activity that's been going on.
So your biggest concern is the big corporations paying those lower rates so that the people own those assets and that's where the income is. You're not talking about the business owner that puts their money back into their business and doesn't pay tax on that money because they're reinvesting it.
The tax code has become so fiendishly complicated in the US that the reality is that there's so many loopholes, there's so many little tax maneuvers that are possible that it's almost impossible to follow the whole system. I mean, in theory, the small business owner who's creating jobs, plowing back into the local economy, of course, he or she should be supported. But there comes a point at which that small business owner may simply be plowing back into the business, not necessarily to create jobs, but really just to benefit from lower taxation. I know this is not an entirely analogous example, but you can look at the huge surge in share buyback activity that's occurred in public markets,
right? And
in recent years as an example of what I mean. In that, if they would,
but you don't have that issue with the small business, right? So the small business isn't buying back its own shares because it's just got a few shareholders. You're not talking about a public company here. So there's no question that there's a different tax regime for the, there's a whole different economy for the big corporate, for the public company than for the private company.
There is, and there necessarily has to be, but ultimately, you then need to look at the consequences of this over time. And I happen to live in Hong Kong, where we have very low income taxes.
You do.
Top rate of income tax of 15%. We have no taxes on dividends, interest income, capital gains, inheritance. And what you see over time is that wealth compounds very quickly.
It does. When you don't have the drag of the taxes, it absolutely does.
Whether you're a small business, whether you're a small business owner or a large business owner, or just simply an investor in financial assets and real estate.
So can I just ask you that question, because you're the expert. I mean, you're in Hong Kong. You've grown up in Hong Kong. You live in Hong Kong. Do you see that Hong Kong, because of its low tax rates, and it's a pretty flat across the board, right? So do you see that's created a big imbalance between the rich and the poor in Hong Kong?
Absolutely, it has. It's not been the only issue. Of course, we've had successive regimes failures in housing policy and in other areas and in education policy, which have contributed very significantly to the wealth disparities that you have here. But the low taxation that we've had that was instituted back in the 50s and 60s, and which has persisted to this day, it was a very, very good thing to have in the early days of Hong Kong's development, when we had a huge flood of immigrants from China mainly, who were fleeing a regime change there, who came to Hong Kong often with very little, and who set up businesses. They set up factories, manufacturers. Hong Kong, until the early 90s, was a significant manufacturing center. That's how Hong Kong first really established itself, rather than as a financial center. And so that was very successful. That was a very successful policy for first and second generations immigrants into Hong Kong. But over time, as those first and second generation wealth creators die off, and they leave large inheritances to their successors.
So does Hong Kong not have a big inheritance tax?
We have no tax on inheritance whatsoever.
Oh, wow. Yeah. See, we have a 40% tax. So that's that you lose a lot of that when you transfer.
You lose all that. But I mean, your thresholds before that bites.
They're pretty high. They're
very high.
You're talking about $12 million. So most it's pretty high.
Most human beings,
will not pay. But when you really talk about the elites, I mean, those people are paying that inheritance tax one way or the other.
They are. I mean, I happen to, my wife's American, so we happen to have spent a lot of time in America and own a home there, and I've unfortunately had to learn some of the intricacies of the U.S. tax code. And
you can postpone, but you can't eliminate. Basically, if you're over that threshold, you can postpone, and you can postpone generationally, but you can't eliminate. So you're either going to pay capital gains, you're going to pay inheritance taxes in the end.
Well, once you hit a certain level of wealth, what keeps you going? What keeps you motivated?
It's an interesting question.
To continue to create jobs and build businesses. A lot of it's about legacy and leaving something to your children, your family. And
of course,
that of course, that incentive shouldn't be taken away entirely. But I do think that, having looked at the experience of Hong Kong, where I mean, let's not beat around the bush. And it was just over 2 years ago that we had people rioting out in the streets.
Right.
And, a lot of the cause of the root causes of that social dissatisfaction that led to that were around livelihood issues. It's young people not able to get on a decent career track because they've not had access to the level of education that they need. Young couples having to pay sometimes $1.5 million US for a 250 square foot home, which
unbelievable.
If you think about 250 square feet,
oh my heavens, that is smaller than my studio.
How you got a big studio? But
I do.
But how do you if you aspire to have a family life and to bring up children, how do you do it in a 250 square foot space? Don't get me wrong. I'm not a rabid socialist. I don't believe that we should have absolute equality of outcomes, etc. There are many reasons why
sure.
people's lifetime earnings and lifetime wealth accumulation will be different. And so in that sense, where the system has imbalances which are leading to huge disparities, which in turn are leading to people out protesting in the street, whether it's in Occupy Wall Street or other movements. These are symptoms that the system is not working. And I'm not advocating that we should go back to anywhere near the punitive tax rates that we saw in the 1970s. But I do think that something needs to be done to make the tax system fairer.
Hey, if you like financial education the way I do, you're going to love Buck Joffrey's podcast. Buck's a friend of mine. He's a client of mine. He's a former board certified surgeon, and he's turned into a real estate professional. So he has this podcast that is geared towards high paid professionals. That's who he's geared towards. So if you're a high paid professional, you're going, look, I'd like to do something different with my money than what I'm doing. I'd like to get financially educated. I'd like to take control of my money and my life and my taxes. I would love to recommend Buck Joffrey's podcast, which is called Wealth Formula Podcast with Buck Joffrey. I hope you join Buck on this adventure of a lifetime. Yeah, it's interesting because, you're right. The people who, particularly the people, I call them the Wall Street people, right, who have so much in financial assets. And I've never believed that Wall Street really produces a lot. Okay. I'm not a huge fan.
Don't worry. I worked in finance. I worked in finance all my life, and I'm extremely cynical about all of it.
Yeah. So, I'm a big fan of Main Street, not such a big fan of Wall Street. And so there's no question, that there, as long as, because the tax law is really a series of incentives, right? And it's just, are we incentivizing the wrong things? That's really the question when it comes right down to it, because most of every tax law is in a series of incentives, right? Do you get a tax benefit for investing here? Do you get tax benefit for this investing there? Do you get a tax benefit for moving to a different country? So whatever it is, it's taxes do incentivize people. And so, I think there is a question, and I'm not saying also that we don't have it's clearly there's this inequality. And I think I'm concerned from the standpoint, I think that if the wealthy don't pay attention to this, I think the wealthy are in trouble because I think you do have upheaval, and that's what ends up. And so I think I'm not saying we don't need to pay attention to it. I'm just looking for, okay, so how do one of the things, and we don't have time to go into it today, but one of my big questions that I keep looking at, and I think you actually said the answer a little while ago. One of the big questions is, how do you remedy that inequality without losing the investment, right? Without losing the investment where it needs to go, whether it's housing or whether it's energy or whether it's technology, wherever it is, because we know Tesla would never have survived without tax benefits. Never would have. Okay. It survived primarily because of tax benefits. And everybody loves Tesla, right? So there's that side of it, but then there's the other side that you need to make sure that that people, it does need to be fair. And you brought up, I think, which I think is the key. And I just, if we can wrap up on this, but you brought up education. And I've thought for a long time now, that really the biggest problem is education as opposed to anything in the financial institutions. And it's that people don't get the education. What do you think?
You're absolutely right. I mean, education is one of the key levelers in society. You can never prevent the wealthy from giving their kids better opportunities,
right? Just
simply because they have access to different people, travel, and many other life opportunities that kids from poorer backgrounds don't get. But education is the key stepping stone towards social mobility. And that's where I think the system, not just in the US, but here in Hong Kong as well, has been failing.
That we can end on that piece of agreement for sure, because I truly believe, and that's why we do what we do, is financial education, because I think when we can get more people educated, we will have less disparity. And I've always thought the difference between a third world and first world country primarily is how educated is the middle class, right? How educated are the workers? Because in the third world countries, the workers tend not to be educated at all. And the better we can get that education, I think what happens is, and the more education we get on things like this, I really appreciate your taking your time, James, for this, and you're taking time to write the book, because I think that financial education that you're presenting in, in your book, Financial Cold War, is so important to understanding what's going on. Because once we understand something, we can actually do something about it for ourselves. So how would we get more information about what you're doing in your work and your recommendations for what people do?
Well, please read the book. It's available in all major bookstores, and you can find more information about it, where to buy it, and about myself on my website, James A. Falk. That's JamesAFOK.com.
Awesome. Thank you, James. Thanks so much for being with us. And
thank you, Tom.
And enjoy the rest of your day in Hong Kong.
You've been listening to the WealthAbility Show with Tom Wheelwright. Way more money, way less taxes. To learn more, go to WealthAbility.com.